Here's a question I get all the time. Ron, should I borrow from my whole life insurance policy to pay off debt? And my answer usually surprises people. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let me tell you about a conversation I had. Client came in excited, just discovered his whole life policy had built up to $85,000 in cash value. His insurance agent suggested he could borrow against it tax-free. Sounded perfect, right? Remember, strategy beats rate always. I can't tell you that enough. Strategy beats rate always. Not so fast. Here's what most people don't understand about whole life insurance cash value. Yes, you can borrow against it. Yes, the growth is tax deferred. But here's the thing nobody talks about. When you borrow from your policy, you're paying interest. And where does that interest go? Back into the policy, sure. But you're still making that payment. Now, I'm not against whole life insurance. It has its place in a financial strategy. We talked about it in how to retire on $31,000 a month with no 401k, no IRA, and using your mortgage. So we talked about that. So yes, I do understand insurance, and I believe in it wholeheartedly for the right purposes. Again, it has its place in a financial strategy. The death benefit protects your family. The cash value grows, and in the right circumstances, accessing that value makes sense. But here's where I see families make mistakes. They look at that cash value like it's found money. They borrow $50,000 to pay off credit cards, maybe knock out a car loan. Feels good in the moment, but they haven't changed the behavior that created the debt in the first place. And now they're making loan payments back to the insurance company instead of to the credit card companies. So what changed? Just who's getting the interest payment? Let me share what I told my client. We sat down and looked at his whole household blended interest rate, not just the credit card rates, not just the potential insurance loan rate. Everything, his mortgage, his car loans, his credit cards, student loans, his HELOC. Turns out if we reposition some of his home equity strategically, we could consolidate that higher interest debt at a lower overall rate and keep his insurance value intact. Why? Because that cash value is still growing, still providing liquidity he might need down the road. See, the question isn't, can I borrow from my life insurance? The question is, should I? That depends on your whole picture. Here's another consideration. The article I was reading recently mentioned accessing cash value through loans or withdrawals can reduce both the policy's cash value and the death benefit. That means the protection you bought for your family, it shrinks when you borrow against it. There's also this, if you borrow too much and the policy lapses, you could face a tax bill. That tax-deferred growth you enjoyed, the IRS wants their cut if the policy terminates before you die. Now, I've worked with families where borrowing from life insurance made perfect sense. Maybe they've had a short-term cash flow need. Maybe they were in their 70s with substantial cash value and minimal debt. Maybe they understood they were essentially borrowing from themselves and had a clear repayment plan. But for most families, there are better strategies. So what does this mean for you? If you have a whole life policy with cash value, don't just look at it in isolation. Look at it as one piece of your overall financial picture. Run the numbers on your household blended interest rate, or we can do that for you. Understand what accessing that cash value really costs you, not just in interest payments, but in reduced death benefit and potential tax consequences. And if someone tells you that borrowing from your life insurance is always the best move, get a second opinion, because strategy beats rate always, and there is no always in creating strategies. This is where having your financial house in order makes all the difference. When you understand your complete debt picture, your cash flow, your liquidity needs, and your long-term goals, you can make informed decisions about tools like life insurance cash value. You might decide the policy is perfect as is, protecting your family while growing tax deferred. You might discover a better use for that equity. You might realize your insurance needs have changed entirely, but you won't know until you look at the whole picture. If you'd like to get help, if you like help getting your financial house in order so you can make smart decisions about life insurance, debt, and your overall strategy, rsrlinks.com/keysteps, rsrlinks.com/keysteps. And let's take a look at it. It's a free tool that walks you through the key steps to organize your finances and identify opportunities you might be missing. Because when it comes to building wealth, it's not about what any single financial product can do. It's about how all the pieces fit together. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management.